Okay. All right.
Where are you based?
Swift Current, Saskatchewan.
Oh, really?
Yeah.
I live in Mississauga, just outside of Toronto. But right now I'm in South Palm Beach. We bought,
Holidays.
well, we bought a place down here during the great financial crisis. So we got a condo for half price right on the ocean in South Palm Beach. So
Yeah.
my mom lives down here, and I've got three daughters. My eldest daughter lives down here. So we come down. It's like a second home, really. You know.
Hmm. So lots of people cashed in on that, I guess, in 2008, and you were one of those that was able to benefit.
Yeah, no, it's to be honest, I wouldn't have. It wasn't for an investment purpose or anything like that. It's that my mom was already living down here, and we were already paying for her rent, and so I figure, if we're already paying for her, might as well buy a place at some point. And
Yep.
we just waited a couple of years, kept our capital powder dry, if you will.
Hmm.
And yeah, it was crazy the opportunities that there were here back in 2009. I mean, you could pick up condos like our building. It's in South Palm Beach, so we're right on the ocean. You could have picked up a condo for $75,000, like a
Yeah.
one bedroom condo, U.S. But
Yeah.
mind you, back then, oh no, it wasn't. I mean, U.S. dollar was stronger, but still, it was crazy. All in this area, you would go visit condos, and there were like foreclosures, and like the previous owners had completely trashed the place because they're so angry they lost it. So ripped all the
Yeah.
light fixtures out, holes in the walls. I've heard stories of others. They pour cement into the toilet, before they
Yeah.
before they
I've heard
before
that.
they hand the keys over to the bank. Because it's their house at the time. They can do whatever they want to it, right?
Yeah. Subprime loans.
Yeah, yeah.
Yeah. You've seen a lot of that. And then obviously real estate has bounced back. So it's turned out to be a good investment. But our dollar would have been approaching par in 2008. I think it might have got up there in 2010,
Well, yeah.
roughly.
Well, when we bought, it wasn't. It was around 81 cents or something because we bought in
Hmm.
April of '09. And typically, what happens when there's a crisis or when there's a bear market, there's usually a flight to safety. And so there's a flight to the US dollar. And so, I mean, it is what it is. But yeah, but it still was a great, we had to, tear everything out. It was like walking into 1973. It was an estate sale, been empty for 18 months, all that jazz. And yeah, so we were just very fortunate, and I wouldn't be surprised if there are that there again is an opportunity like that, whether it's this year or in 5 years or in 10 years. Um, the path we're on is not sustainable. I mean, they're going to do.
Well, what did Trump announce the other day? I don't know if it was real or not, but he wanted to spend 200 billion on buying mortgage bonds.
Yeah, a really bad idea. So I wrote about
Yeah.
this. I don't know if you know, but I have a free blog. It's a weekly blog called Paulitical Economy. Instead of political, it's
Hmm.
my name, Paulitical Economy. And he announced two measures last week. The first one was that he was banning large institutions from buying single family homes. And so that's a good step. I mean, they're not a huge part of the market, but it'll help at the margin, even though the last few years they've been net sellers because financing costs went up. And the other measure was instructing Fannie Mae and Freddie Mac to buy $200 billion worth of mortgage backed securities.
Hmm.
Now, these two entities have been buying like 90% of mortgage backed securities over the years, which served to drive the 30-year fixed rate mortgage down rate low or extremely low. And so, and it drove housing prices higher. It doesn't
Hmm.
make housing more affordable. What it does is temporarily make mortgage payments more affordable, but it makes housing prices more expensive as time goes on. And this started in earnest in '01, which we can talk about, and it's a big part of the thesis for my book. And so, it's political. It's very short term oriented. Most politicians, they're not bad people, but they think in immediate first order effect consequences of their actions. So if I instruct the GSEs to buy $200 billion worth of mortgage backed securities, that will lower the fixed rate mortgage and make mortgages more affordable for people. And they don't
Mm-hmm.
think, well, okay, by the end of the year, house prices are going to start to soar again and they're going to be more
Yeah.
expensive. And you're going to contribute to the housing affordability crisis. I mean, it's nowhere near bad down there as it is up in Canada, of course. I don't know what it's like in Saskatchewan, but Toronto, Vancouver, I mean, it's terrible.
Yeah. Real estate prices are all smaller cities staying fairly flat, but Saskatoon, I've seen prices are starting to go up, and it's same thing as the interest rate comes back down. The Bank of Canada keeps dropping it by a quarter point,
Yeah.
and then they just been doing that, and now people they can afford that mortgage again, so they're buying more, and supply and demand, and up it goes. So that's it. How do you win that? There's no balance. Where is the balance there? You want people to make money on real estate, but then you want people to be able to afford real estate that's not subsidized by the government.
Well, no, exactly. And we could talk about this, but I talk about it a lot. House prices have no business going up. We've all accepted that because that's what they have done. But a house is not a productive asset. In a free market capitalist system, you should only be benefiting to the extent that you're benefiting somebody else. Any capital wealth that you have is supposed to be a reflection of the wealth that you created and fairly exchanged with someone else out there who also created capital, and they fairly exchanged their capital for your capital. So it's a win-win situation. What we have now, increasingly, stock markets is a win at somebody else's expense. And housing market, you make money on your home, it only comes at somebody else's expense. There is no win-win.
Mm-hmm.
We can go into details exactly why that is and how that works. And so, yeah, again, it's just because politicians, central bankers don't think things through. They're very short term, election coming up. Economic laws can be very inconvenient. And we're paying the consequences of that mindset. And
Mm-hmm.
today, with an increasingly divided society, and it's not sustainable. So
Mm-hmm.
it's going to end because the math no longer works. The math was just getting more and more difficult. Now it's getting to the point it just doesn't work. The
Mm-hmm.
average age of the first time home buyer in the US is 40 years old. This is a joke, you know?
Yeah, the next generation might not own homes. I mean,
No.
and working two jobs and overpaying for the home you do have. Looking at something worth 350,000 where it needs a ton of work, and good luck getting your money back out of it for the next 20. Oh, well, who knows how long. You hope you get your money back out of it, but a lot of people look at a home and they just want to have the home and a place to live in, a place to raise their kids, and they're not really concerned about what the asset's going to do over time
No, exactly.
or what it's going to cost them after interest,
Yeah.
what you're actually paying for your home.
Yeah.
And first-time home buyers can get it done for 5% down.
Hmm.
Sounds great, but it could bite you big time on the back end.
Oh, yeah.
So
Throw in
so just a little bit of
this and stuff.
history on you, I guess, before we get carried away. Just your experience in this, because you have a wealth of knowledge on this, which I think we're going to see. You're 30 plus years. I mean, professionally as investment management, and then whatever you've done since retirement, which was 2023. You formally retired
Yeah.
from Mackenzie.
Yeah. So I guess that's retired from Mackenzie, but not retired.
Yeah. Yeah. Now you're doing what you want to do. You wrote a book, which is kind of points at the problem you've discovered over your career, of which I'm sure there are many.
Mm-hmm.
But what got you into money, into investment as a young man? How did you find your path there into Mackenzie?
Yeah. So when I was I grew up in Montreal, and when I was at university, I took a very long path through school for various reasons. And so, even when I was 24, 25, I had no idea what I wanted to do for a living. So I was just taking courses at Concordia University because I knew it's important to stay in school. And my big passion was, thirst for knowledge. So I just do what I needed to do at school so I could get home and read my books on history, philosophy, environment, nature. I'm a bird watcher, so I just thirst for knowledge. It's like that Mark Twain quote, "I never let school interfere with my education." That's sort of the way I
Hmm.
felt at the time. And then it just struck me one day. I was taking an investment management course or investment theory course. I said, "Oh my God, I didn't even know this existed." I was very naive. And because I'm decent at math. I'm not a math genius by any means, but also I always excelled at math. And so I figured, wow, this, math, accounting, I like, psychology, history, it's going to involve so many different things that I can bring to the table. Like detective work, trying to figure out the accounting, do I trust management, all this kind of stuff. And yeah, so then I just started working towards that. So that would have been maybe 1986. Yeah, 86, 87, something like that. I was 25 and couldn't find a job in Montreal. I wasn't fluently bilingual. And then 1990, I moved to Toronto and literally sleeping on a hardwood floor of a bachelor apartment at Yonge and Eglinton, which is sort of like uptown part of
Hmm.
Toronto. Uh,
What was housing doing at that time in Toronto
Yeah,
during
so
those interest rates?
housing, it just peaked. You just had that housing boom of the late '80s, and it just started to roll over, so the economy was rolling over in Montreal and Toronto. So, it was a rough time. No, obviously, I wasn't trying to buy a home. I could just barely afford
Hmm.
rent of a bachelor apartment, sleeping on the floor,
Yeah.
and, but the economy was already weak, and so it was tough finding a job. And so my first job was at nights working in a video store. And this is all happening when I was 29 years old. That's how I got my start,
Yeah.
and I love Toronto for that. I still feel that way. If you come to Toronto, I mean, no city's perfect, of course, but you come to Toronto if you really want to work and got a good work ethic, and you could be dependable, and people can trust you, and you're not a jerk. You can make a living. It's
Hmm.
now at least back then, housing
Yeah.
costs now are through the roof, and we can talk about that. But yeah, and then I knew I wanted to be in a invest or analyze companies. I had no idea the structure of the industry. Again, I was very naive, and I sort of went here, did that, blah blah blah, and eventually I got on the trading desk of CIBC World Markets. That was a great job, and then I was hired by one of my clients who was a mutual fund, and was a couple of years there, and then from there I went to Mackenzie Investments, joined them in February 2000, and that's where I spent the rest of my career. Um, yeah, and it was just a fantastic job. Loved every aspect of it.
Hmm. So yeah, like 30 years later, there you go, flying by the seat of your pants, and you spend most of your time in Mississauga, you said, or
Yeah,
a lot of it in Toronto, and
yeah. So I live in Mississauga,
yeah,
but obviously work downtown Toronto.
yeah,
And but yeah, like I mean, to your point, I was flying by the seat of my pants. Like I had no idea how things would work out or what I
yeah,
would end up doing. And I tell this story to a lot of younger people these days and in prior years. That sometimes you get this feeling, well, you have to know what you want to do, and you have to have be making this much money by the time you're that age, and you got to get your first home by the time you're this age. No, just everybody's got a different schedule, different path. follow your dreams. If you can't do your dream job, do any job, just do it well. And you might find that
Yeah.
that job that you didn't think you would like, you end up liking,
Hmm.
and yeah, just I had when I moved to Toronto, I came with this attitude of do no harm. I didn't want to be a burden on anybody, either financially or emotionally or physically. And so for my weekly blog, I always sign off with be free and do no harm. And if you're being free and doing your best to do no harm, it's almost impossible not to have a positive impact on society. I believe that. And yeah, so that's how I ended up managing money.
Man, if every large hedge fund manager, or, BlackRock and those guys could say do no harm, maybe their philosophies might be a little different.
Well, yeah.
So you're probably a naive junior financial advisor or something of that role, and your eyes are probably being opened, and you probably learned a lot in a short period of time, and advanced through the ranks and started to handle. Well, you worked your way up to what was it, a $10 billion hedge fund management position,
Not a hedge fund, a mutual fund.
mutual fund.
Yeah.
So you're investing money for a large group of people. What was the strategy for you guys? Obviously, it's probably a very safe strategy, long term growth. But how did you approach that? And then your personal side of investing, was it a totally different approach?
Yeah, no, it's completely aligned, which I think you can do your best work. In my opinion, your investment philosophy for your clients needs to be a true reflection of who you are as a person, your values and stuff like that. And so our investment style was and still is at Ivy. The team that we built together is still doing it, and got a lot of my money with them. Is looking for it's called high quality. So what we're doing is looking for high quality businesses, looking around the world, and I always felt that we had a very important role to play. Now, earlier on before we started, we were talking about, in a free market capitalist system, you should only be benefiting to the extent that somebody else is benefiting, not benefiting at somebody else's expense. So, as an investor, mutual fund manager, looking for high quality businesses, we would take the savings of Canadians who, through their own hard work, either their own business or working for someone else, had created capital, and they save some of that, and then they give us that capital to sort of augment their future financial security. So we would take that capital, look around the world for who we thought were the best businesses who were going to put that capital to the most productive use, and do so carefully and grow that capital. And so they're investing that capital to create more capital. That increases their profitability. They can hire more people. They can pay them more. They can expand, launch new products, reinvest in R&D and innovation, and improve the product, or, or make it more efficiently so they can reduce the price. And the increased profitability of all this capital drives the share price higher of the company. And so then our clients benefit from that. Their portfolio goes up. They pay their financial advisor a fee. We charge a fee. They're making money. The company they will invest in is making everybody through the whole chain is benefiting. And that's the way it's supposed to work. Now, increasingly, it's not working that way. But that's why when you see stock markets going up, if it's a reflection, an accurate reflection of all the businesses within the stock market creating more and more capital, that rising share price or rising stock market is a symptom of all the stuff that's going on within those businesses. And
Hmm.
that's good. That results in what's called a wealth effect. And that's a real wealth effect where people look at their portfolios going higher, they feel wealthier because they are wealthier. And then often people will go and spend more money. Oh, I made, you know, a good amount of money on my investments last year. Maybe I'm going to upgrade my car, or maybe I'll go on a vacation or something like that. Great. But if central banks, what they started to do was focus on asset prices first and then the economy second. So instead of establishing the conditions for the optimal allocation and investment of capital to drive stock markets higher, instead, they took interest rates down to zero and started printing trillions of dollars to buy assets to drive the stock markets higher first and hope that that would drag the economy up with them and hope that the benefits of doing that at some point would trickle down to everybody else and not just the top 10% who own most of the assets. So, and this is not a conspiracy theory. They will tell you.
Where did this philosophy start? Like who decided that was the approach to take and started to do that?
So, yeah, they won't tell you that we are trying to enrich the top 10%. And again, they're not bad people. Don't get me wrong. I do believe that they actually thought this would ultimately benefit everybody else.
Mm-hmm.
But I noticed it. I had no idea this was going on at first. I noticed it in early 2000s. So you remember the dot-com boom in the late 1990s,
Mm-hmm.
ridiculous valuations, Nortel, all this kind of stuff. And that created a wealth effect. So that was good for the economy. Well, it's not necessarily good for the economy. It's good for final spending or GDP. And that's one thing we can talk about later if you want. Economists, policymakers look at gross domestic product to determine whether or not the economy is in good shape. But gross domestic product, it's just a measure of final spending. And so final spending is growing just because people are taking on all kinds of debt and GDP is growing. Well, it's not sustainable. But anyway, so during the 1990s, stock markets are soaring. Alan Greenspan, who was head of the US Federal Reserve at the time, used to talk about how much the wealth effect from the rise of the stock market was contributing to GDP growth. Then the whole thing crashed. So you had a negative wealth effect. People spending less because they see the value of their portfolios going down.
So is this based on overvalued tech companies? A
So
lot of it? In
some,
Canada, but I mean, then the housing crisis, yes,
yeah.
but
So some of it was based on overvaluation. Some of it was based on real productivity growth. In the 1990s, with the internet, dot-com technology stuff, there was real productivity improvements there. And it was real, but it was overdone. And then so you had a very mild recession in 2001. It was only one quarter of economic contraction. It wasn't even two quarters. And so you had commentators like Paul Krugman of the New York Times and Paul McCulley of PIMCO, big bond investor, recommending that the US Federal Reserve should start a new wealth effect, but this time start it in housing, because more people own housing than stocks, and so it could have a bigger impact on the economy, or at least a bigger impact on final spending. So despite the fact that it was a very mild recession, just one quarter, the Fed took the Fed funds rate down to 1%. Now, normally this would be considered emergency levels. It hadn't been that low in decades. And they kept it down there, or kept it at very low levels for about 3 years. And of course, the housing market responded. And you had that crazy housing bubble in the 2000s. I think it peaked in 2006. And then people were extracting hundreds of billions of dollars of equity from their homes and spending it. And each year, Alan Greenspan would talk about how much equity was being withdrawn and how much it contributed to GDP growth. So everybody thought this was a great idea. When this was happening, that's when I first started to wake up. So, oh my, what the hell are they doing here? How dare they distort asset prices like that? And, because like as I said before, as an investor, I thought I was playing a very important role by being very careful about which companies got access to my client's capital. And if you're a basket case and you're not allocating the capital efficiently or properly, or you're running too much debt, or you're making crazy acquisitions, well, guess what? No capital for you. You starve those
Hmm.
businesses of capital, and it forces management to either be more productive, reinvest in their business, or leave. The creative destruction that Schumpeter used to talk about. So,
So just to simplify it slightly, just to clarify it in my mind, these people, these mortgage rates were so low that they would borrow against their home again and dip into that equity because it's so cheap to borrow the money. And then they would just go spend it on whatever they needed, the new car or the renovation or things like that.
yeah,
But housing prices were also inflated because the mortgage rates were so low at the same time.
exactly, exactly. So,
So they're getting themselves into a very precarious situation. This is leading into 2008 very much.
correct. So when you drive in mortgage rates lower, it doesn't make housing more affordable. It makes mortgage
Yeah.
payments more affordable. That only serves to drive housing prices higher and ultimately
Hmm.
results in a housing affordability crisis, which is exactly what we have in Canada, Australia, and now you're having it in the US. So,
So back in, yeah, you sitting there watching this now, and you're running some serious investment strategies, and alarm bells are starting to go off in your mind.
yeah,
You've got your own customers, I'm sure, that are borrowing against their homes, and you're watching this happen. So yeah, continue on from there, I
yeah,
guess,
okay.
as you watch this happen. Very interesting.
Yeah, so, now it wasn't as crazy in Canada, but it was crazy. And and you can see on price to house price to income charts where everything turned around. Everything started back in 2001 with this Fed policy. And the Bank of Canada followed the US Federal Reserve, took interest rates extremely low. And for about 20 years, up until 2001, the average price, home price to after tax income in Canada, was ranged from 6 to 8 times. But as soon as you get to 2001, Bank of Canada takes rates to, I don't know exactly what, very low levels. And the price to income starts to rise like this, and well above the average of 7 times from the previous 20 years. Then during the great financial crisis, I think house prices, we got up to, they were about 10 times price to after tax income in Canada. So
Wow.
very expensive. And during the crisis, they fell a bit and they went to 9 times, which was still very expensive. But at the time, Mark Carney was head of the Bank of Canada at the time, took interest rates down again to try and get house prices back up to even more expensive levels. By the time he left, they were like 12 or 13 times after tax income. Now, again, he didn't do this because he was trying to enrich somebody at the expense of somebody else. They all just thought this was good for the economy. It's not, it's
Hmm.
terrible for the economy. And then in the US, when the crash hit, you had around 25% of mortgages that were underwater on their mortgage, or negative equity position, or upside down, as they like to call it. So their mortgage was worth more than the house. And so there was what's called jingle mail, because in a lot of states in the US, there's no recourse if you stop paying your mortgage. So they just mail the keys back to the bank. And then other
Okay.
people, they would stop making mortgage payments before they stopped making car payments. And the idea was, I can sleep in my car, but I can't drive my house. And so this was really bad policy, like trying to encourage people to buy homes that they couldn't really afford, and then putting the risk of that on the taxpayer through Fannie Mae and Freddie Mac and all the hundreds of billions of dollars in mortgages that they were buying.
Well, as a bank, when you make money off interest, but the interest rates are so low or even subprime, your primary method of making money is, I guess, one, paying an investment firm to make you money, or two, a lot more mortgages to more people.
Yeah, yeah, volume.
Volume.
Yeah, and
And then they end up with a lot of bad mortgages.
and so this created, when the housing boom was going on in the States, it created what I call a fake wealth effect. So, yes, the value of your home was going up, and you as a homeowner were wealthier, but society at large was not any wealthier because the rising price of a home does not reflect any more capital being produced. So we live, my wife and I, in Mississauga. We bought our house in 2001, just happened to buy it right when this housing wealth effect policy started by the Fed. And so our house has gone up in price 4 times. So in a free market capitalist system, whatever wealth you have is supposed to be a reflection of the wealth that you have created and then fairly exchanged with someone else for the wealth that they created. Now, when we make 4 times on our home, who else out there is also 4 times better off? Nobody. But it's even worse
Nope.
than that. Not only is there nobody 4 times better off, but cumulatively, people are 4 times worse off because they have to pay 4 times what we paid for an asset that is not a productive asset. Our house is not producing 4 times as much stuff as it did back in 2001. It hasn't increased 4 times in size. It's in the same location. It's the same economic good. So all it is, when we make 4 times on our home, is a redistribution of wealth within society from the bank account of a younger couple or newcomers, immigrants to our country, who have to pay 4 times what we paid for the same thing. And this, in my opinion, is immoral and and completely unfair. All done with good intentions, by the way. I truly believe that. Um, but to me,
Short-sighted though. Very
very
short-sighted.
short-sighted and arrogant and arrogant and and these people are not stupid and they're not bad people either, but it's ego and reputation that gets often gets in the way from admitting that, well, maybe that wasn't such a good idea after all. And the problem, and I get it, because the problem now is to fix it, there will be pain. And it is unavoidable. I mean, you'll hear these Canadian politicians say, oh, we need housing to be more affordable, but we can't have housing prices coming down because a lot of boomers are relying on their housing wealth for their retirement. Well, guess what? It's the next generation that, in part, is funding the retirement of baby boomers like me. I'm 64. So it's the enormous mortgage debt of the next generation and immigrants that is helping to fund a retirement that we haven't totally earned.
Hmm.
Now, no one my age, boomers, we haven't done anything wrong. We all played by the rules. We all worked hard. We went to school, we did our thing, played fairly, and we all fell for the, well, houses just go up in price, so you got to get on the housing ladder. I hate that term. You know,
Yeah.
like I understand why people say it because that's what's happened. That's what you do.
Starter home.
Pardon?
Get your starter
Get your
home.
starter home, and then and yeah. So I mean, there's ways to fix it, but not without pain. And when I tell people my age this, first, of course, they don't like it. I mean, who does? And everyone likes to think, oh, I know something about real estate. I timed that buy purchase pretty well. No, you just got lucky, right? You just
Hmm.
happen to be older and benefited from these central bank policies that redistributes wealth within society. And so the vast majority of people who, I tell this to, they get it right away. They understand. They understand it's not fair. They understand that a good part of their wealth or their housing wealth, not all of it, because if you've paid off your house, then that hasn't come at somebody else's expense. But if its price is shot through the roof, then yes, it has. And yeah, and so they understand. But But to change it, to fix it, somebody, some policymaker has to make a decision. Or they just let things unfold on their own, and then they'll blame tariffs, or they'll
Yeah.
blame China, or they'll blame somebody else or whatever. Look for somebody else to blame. That's why your house price is down 35%. Well, no, your house price is going down 35% because it's going back down to fair or intrinsic value, a value that's affordable and, as it should be. But it's really not fair, particularly for younger people who recently bought a home at very high prices. And I do believe that there should be help if prices do collapse for at least first-time home buyers. There should be help, from government, but it's not really government, right? There's no such thing as government subsidies or government benefits because the government doesn't produce any capital. All the
It's taxpayers.
taxpayer benefits, taxpayer subsidies. All the government is very important, by the way. I'm not anti-government at all. And I'm pro-welfare state as well within reason, right?
Hmm.
But I'd be encouraging people not to work either. But I'm pro-government. But the government, for the most part, doesn't produce any capital of its own. It's a facilitator of capital creation by establishing
Hmm.
regulations, contract law, national defense, personal security or defense via police force and stuff like that. And so all the capital that government spends, it obtains in one of three ways. A most obvious form is taxation. Second is by borrowing. And the third way is by printing money.
Hmm.
So let me quickly explain how that mechanism works and how the government extracts capital from society when they print money. And it comes down to the reason they get away with it is because a lot of people don't differentiate between capital and money. So both very important, but both very different. So capital is anything that you produce, a good or a service. Your podcast, you're producing capital, your listeners consume it. So let's say you make a bike and I make a suit. We both just created capital. There was no bike in the economy, there was no suit. We both created one, and now there's one of each. Society is that much better off. And very importantly, it didn't come at anybody else's expense. Nobody suffered because you made a bike and I made a suit. Then we fairly exchanged the bike and the suit with each other. That's called direct exchange or barter, right? But you can't have a large economy with barter because it just doesn't make any, you can't do all the computations. How many kitchen chairs do I have to make to book a flight to Florida or something
Hmm.
like that? So we use the medium of exchange called money. So all the capital that's being produced in the world is what makes the world go around. Money is just used to exchange all that capital that everybody is creating. So now let's say you make 10 bikes and you sell them for $1,000 each. They're nice bikes. So you put that $10,000 in your bank account. And now what that $10,000 effectively represents is the 10 bikes that you created and you sold to somebody else. So that you're temporarily storing those 10 bikes in your $10,000 of cash. That's what gives that
Hmm.
money value. Now, you don't spend it right away because you're going to save it to the end of the year. You're going to go on a nice trip or something. Now, before you get a chance to spend your $10,000, let's say the Bank of Canada doubles the money supply. Now, they wouldn't, but just assume they did.
Hmm.
Now, when the Bank of Canada creates money, it just creates it out of thin air, pushes a few buttons. The Bank of Canada does not create any capital to obtain that money. So that newly created money has no capital stored up within it, effectively. But it obtains capital, it obtains value when it comes into the economy by extracting capital from the rest of the money already in existence. So as soon as that doubling of money comes into the into the economy, it extracts 5 of the bikes from your $10,000. So your bank account still says that you've got 10,000 bucks in your bank account, but instead of storing 10 bikes, it only stores 5 bikes. So now your $10,000 will only buy half as much as it would have done before the Bank of Canada doubled the money supply, which of course is inflation. So that trip that you were going to pay $10,000 for after the Bank of Canada doubles the money supply, that trip is now $20,000. So that's how the government obtains capital by printing money. And yeah.
So just a couple of points, I guess, on that. As a great explanation of inflation. When you said your home makes 4x what you paid for it, I think what a lot of people are doing is they see that, and a lot of people have made even doubled the value of their home in a short period of time in the last decade or something like that, and they're excited that we're going to move into a bigger house, so they misappropriate that equity because they sell that house, but now they're buying an overinflated bigger house.
Yeah.
And they really have, like you said, nothing for it. Just a house that sits there and does nothing for them, with more rooms, and it's nicer.
Yeah.
They don't, guys that get to retirement, or maybe we see it all the time. People cash out in BC. They cash out on their home that's gained a ton of value, and they move to Saskatchewan, to these small towns, and buy these houses for next to nothing, and they retire.
Yeah.
And that's probably, the best use of that capital is use it in retirement age and downsize and buy something that's actually worth the money you're giving for it.
Mm-hmm.
And then have your money grow passively in the bank account, get your, 5 to 10% a year, and then just ride off into the sunset. But a lot of people, especially I'm mid to late 30s, they just want that bigger house and the bigger car, and they access the capital and misuse it that way for a very much depreciating asset.
Yeah.
And a lot of people come out of school, high school, especially with no financial literacy. Nobody teaches them these things. It's amazing how much debt you can sign up an 18-year-old kid, and they have no idea what debt really is, and good debt and bad debt.
Yeah.
It happens all the time, and it's advertised on billboards.
Well,
Make payments on a new cell phone.
well, that's the problem, in that policymakers have encouraged this sort of mindset. They have encouraged the bad sort of debt. And it's because it's sort of the Keynesian economic way of looking at the world, where they believe that consumption is the fount of all economic prosperity, that you can consume your way to riches, right? And they believe this because GDP, or final spending, about 2/3 of it is done by consumers. And so if they could get consumers to spend more, then that boosts the GDP number, and it makes it look like the economy is in good shape. Well, no, it's not in good shape. All you've done is encourage people to take on more debt for consumption spending. That's not good. Now, we've all done it in the past, right? I mean, it's like within reason, but it shouldn't be a way of life. You just get you get yourself into trouble. And there's nothing wrong with debt. If you're borrowing to invest, or you're borrowing for your home, or you're borrowing to buy a car and stuff like that, and you pay it off as quickly as you can, there's nothing wrong with that. But yeah, there was an article in the Globe and Mail. I commented on it in my blog posts, and somebody said that, people are becoming more comfortable with debt in Canada. No, they're not. They just don't have any choice, right? If you want to get by, you have to take on so much debt. And, there's always these financial institutions who are there, ready to make it easier for you to take on more and more debt.
Mm-hmm.
And, we're creating a society of debt slaves.
Yeah.
And, it's not right.
It's not a comfort with debt, it's normalizing debt. And that's not people's own doing. That's the government forcing it down the line onto them. Life's too expensive. Nobody can pay cash for anything anymore. I guess, and then with the home buying thing too, is their approach to it now is if you have kids and you've got a bank full of money and a bank full of equity, why don't you help your kids with that down payment on that new home? Access your life's hard work to help your kids. And now there's strategies being built around accessing boomer cash or family wealth to get it done for this younger generation, which is just shameful. I think the fact that it's got there. How much of that did you see in your life as an investment strategist?
So, I've only been hearing this over the last few years, that banks love saying this, the bank of mom and dad, and they love that
Mm-hmm.
because they think, well, this is going to perpetuate the housing bubble. And, I mean, there's nothing wrong with parents. Of course, there's nothing wrong with parents helping their kids. And I think they should help their kids if parents have benefited inordinately from their house going up in value and your kids are struggling to buy a home, why wouldn't you help them? And so, but the problem is that not all kids have parents who bought homes.
Mm-hmm.
And then not all parents who have a home have enough savings to retire if they lend the overinflated value of their home to their kids. And this is another negative impact on the economy that this whole housing wealth effect policy has resulted in. So, typically when people would buy a home, your goal was to pay it off as quickly as possible, right? Then you used to have these mortgage burning parties where you burn your mortgage documents, you invite people over, mortgage free, and everybody be happy for you. People don't do it now because it looks like you're bragging, right? Like, because most people are
Yeah.
not going to get out from under their mortgage. But, you would pay off your mortgage. And, if you needed more, then you would save. But with policymakers driving housing prices higher, people felt that they had to save less than they would have if their house price wasn't going up so much. So there's a term in economics called time preference. So, what time preference is, if you have a high time preference, then you want to spend and consume more of your money today and you'll save less for the future. So, you have a very high time preference. If you have a low time preference, then you're okay with not spending and consuming or having so much fun today. You'll spend less and save more of your money, invest it such that you cumulatively you can consume more through your lifetime, but you'll consume more of it in the future. So by driving house prices higher, it encouraged people to save less in society. So society's time preference went up, which means savings went down or was lower than it otherwise would have been, which means there was less invested in the economy than there otherwise would have been if central banks hadn't driven housing prices higher. So there's less wealth being created in the economy than there otherwise would have been. So, I mean, there are so many negatives from this sort of thing. Um,
Well, and how many people can even afford to invest in the stock market? A large portion of Canadians and North Americans are paycheck to paycheck,
yeah,
or not even. They're borrowing, they're maxing out credit cards and that kind of lifestyle, and that's growing.
yeah, yeah. Oh no, it's terrible.
Yeah. So, why does the bank choose to print the cash? What fuels the inflationary money printing?
So there are a number of things. First of all, it funds government spending. There is something called seigniorage that the government, well, they don't earn it; they obtain free capital by printing money. Um, and And the focus of central banks, and it's not just the Federal Reserve Bank of Canada, but it's all developed economies, has become asset prices. So starting, I mean, it's always been a focus, but in earnest in the early 2000s, as I like to say, this is my opinion, by the way, central banks sacrificed the Main Street economy on the altar of higher asset prices. And so after the great financial crisis, when asset prices tanked, housing in the States, stock markets, it made everybody's collateral worth half of what it was before. And so the Fed's, oh, we got to get the value of that collateral higher, even though a lot of it was garbage, junk. And so they drive interest rates down to zero, print trillions of dollars, and bought 10-year US Treasury bonds, bought trillions of dollars in mortgage-backed securities. This results in what they call a portfolio effect, where most of the assets were bought from hedge funds. So banks were used as a conduit by the Federal Reserve. And there's a paper on this in 2013 by Seth Carpenter, who worked at the Federal Reserve. You can see it on their website, and they talk exactly about this. Now, they don't call them hedge funds, they call it families. But then he explained later that most of the families are hedge funds, because it doesn't sound good, right? And so hedge funds, they would sell those assets. Now they've got to go out in the market and buy more assets to replace the ones that they sold. And yields are being driven down lower. And when you drive yields down lower, you drive asset prices higher. And it sort of cascades through the system and eventually drives equity prices higher. So this their goal was, rather than like now the interest, let me back up a second. The interest rate, as James Grant would tell you, is the most important price in markets, in the economy. Interest rates is like a regulator, and it tells you what's going on in the economy. Now, interest rates can only function properly when they are not being distorted by central banks. So there's something called the natural rate of interest. So the natural rate of interest is determined by millions of market players with their own skin in the game. So if you're deciding, let's say you want to lend $10,000 to Apple, and so Apple will say, well, here's the interest rate we're willing to pay you to borrow your $10,000 for 5 years. And then you say, well, no, that's not high enough. I'm going to lend it to somebody else. And if there's enough people like you saying that, because you're looking at the Apple business model, you're not sure about the new model of the iPhone or whatever, you're doing your analysis, you think it should be 7% instead of 6%. And so that forces Apple to either fix their business model, and it's not broken, it's a great business, don't worry, or increase it to 7% so they can borrow your money. But instead, the Federal Reserve will come in and buy trillions of dollars of assets to drive those interest rates down. And so now your Apple's able to get your money at 6% instead of 7%. So this natural rate up here is what results in the optimal allocation of capital, which results in the greatest economic growth and the greatest wealth creation, because it's determined by people who have something to lose, their own skin. They're the most careful. So it's not just about return, it's also about risk, right? So that's the natural rate of interest. Central banks have become focused on what's called the neutral rate of interest. It's a very different thing. So the neutral rate of interest is the rate of interest which keeps the economy growing, or GDP spending, at a certain level without causing inflation. Right? So we're at the natural rate, let's say. Now, they encourage too much debt and the economy starts to slow. And so to get the economy growing again, the central bank has to lower the rate below the natural rate so people can borrow more and spend. And so that's what they do. They start borrowing more and the economy starts growing, or at least spending starts growing. But then they have too much debt again. So now they have to lower the neutral rate even more. And now so each time they do this, the neutral rate is growing lower and lower from the natural or optimal rate of where the economy will function best. Now, there's an economist called Ludwig von Mises. He was the king of the Austrian School of Economics. I think he died in 1973 or something like that. He said, it's my favorite line in economics. He said that policymakers can deny you the right to receive this natural rate of interest, but they cannot eliminate its existence. They can't change the fact that this is the optimal rate and results in the greatest wealth creation and most fair distribution of that wealth, by the way, in the economy. But they can deny you the right to receive it by taking the neutral rate down to here. And yeah, so I can't remember your original question, but
Well, no, it was why the government inflates,
oh,
but I
sorry, yeah.
mean,
So,
and now like I can see why, Trump wants to stop companies from buying single family homes, because the bank is going to become hell bent on making money on these homes, and that is going to be driving down interest rates and creating a bubble again. It's a dog chasing its tail, and it's troublesome as a home buyer because everybody wants to make money on real estate, and you don't want the economy to stay flat. You do want growth, but I don't know if the government needs to be making money less on hard assets and more on the growth of businesses succeeding. And they're driven now on hard asset growth. And that's by driving down interest rates and getting people into more debt. And they seem to be addicted to that.
no, exactly. And as I said, there's no real wealth creation when you just drive asset prices higher. It's the same
Yeah.
amount of capital. All that's happening is you're forcing people to pay more money for the same amount of capital that's in society. And ultimately, there's less capital than there otherwise would be because there's less investment, because time preference went up, and you distorted the natural rate of interest, so capital gets misallocated.
Yeah.
But in the Bank for International Settlements, or BIS, they had a report on zombie companies. And they had a report, it was before COVID. And even back then, I think it was something like 17% of companies, listed companies in developed Western economies, were what's considered zombies. So, zombie is a company that doesn't make enough operating profit to even pay the interest expense on its debt. Never mind pay the debt back. So these are
Welcome to
companies.
Canada.
Yeah, I mean, there are a lot in Canada as well. In part,
The government of Canada.
sorry.
The government of Canada is pretty much in that boat.
Well, I mean, the government of every Western
Yeah.
democracy is like that. They're all playing
Yeah.
by the same rule book.
Yeah.
We've got our own issues in Canada, of course, and I love Canada, but we've gone down a bad path. But
Yeah.
these zombie companies, the only reason that they are still alive is because of central banks driving that rate far below the natural rate. So these companies could survive and not lay off their employees. But they do so at great expense to the economy, at great expense to the public at large, because they're destroying capital, they're consuming capital. That's not the way a system is supposed to work. If you're no good at what you do, if you're a basket case, the best thing you can do is either change your ways and be more productive, or go do something else.
Mm-hmm.
But you've seen productivity growth grind lower for decades in developed economies because of this. Now, it's not fun when somebody loses their job. Nobody's saying that. But,
No.
but to keep basket case companies alive, just to protect jobs in the short term, it results in much greater job losses in the future. And
Mm-hmm.
it results in a much more divided society, growing wealth inequality. There's nothing good in it, but it's like we're saying earlier, it's because of the short-term focus on the immediate first order effects, consequences of your actions, rather than second and third order effect consequences that are a few years down the road, sometimes 5 years, sometimes 10 years. But, that time period can be a lot longer than an election cycle.
Yeah.
And it's tough to make the right decision sometimes.
I think it's tough too because we're making less things. Like we're generating less capital and we're importing our capital assets.
Yeah.
And a country that's making less things has to find a way to grow the economy, and it creates a problem that you have described. And And then you get companies that do fail. I just think of when Trudeau bailed out Bombardier
Mhm.
uh, and to save 2,200 jobs. It sucks. You don't want people to lose those jobs, but companies have to be able to fail.
No, exactly.
You want the ones to succeed, but you have to let companies to fail. You just cannot keep subsidizing and paying for these companies to be unsuccessful.
Well, yeah,
And
and
there's a lot of tech companies in that seat, I think, right now that are
yeah,
spending a ton of money in advancement, and the government wants the advancement, so they're helping them along, but at great expense to the taxpayer.
well, it is, and in part, and don't get me wrong. I mean, in some ways, I don't blame politicians because they have. I mean, they're under enormous pressure to be seen doing something, and most people do think it's a good idea to bail out companies, to fiscal stimulus deficit spending is a good idea. It's not. It's a terrible idea. But that's what people are being conditioned to believe in, to accept as received wisdom. And so if governments don't do it, well, guess what? You're not going to be around very long. You're going to be elected out of office. So we,
Hmm.
as a society, we've been demanding from our policymakers the wrong thing, in part because they've tried to convince us it's the right thing to do.
Yeah.
And the laws of economics can be very inconvenient. And economics is not a hard science. It's not a natural science like physics or chemistry. It's a social science, more like sociology based on human action. So there are a number of different schools of economic thought out there which tell you what the right thing to do. So there are schools of thought out there that tell you deficits don't matter. Debt doesn't matter. You need inflation for an economy to grow. No, you don't. But they've convinced everybody that you do. That's why the Bank of Canada has this 2% inflation target, as many other central banks do. It's ridiculous. And um, and so politicians, this is exactly what they want to hear. They'll find some school of economic thought which justifies their, spending, profligate spending programs, and convince themselves that, yeah, this is the right thing to do and this is for the better good and all that kind of stuff. I think they actually do believe that,
Yeah.
but it's not. you know and
So if
likened it to, sorry, the some economists liken this to, like, it makes no sense to get angry at the law of economics because they are what they are. So it's as
Yeah.
silly as blaming gravity for plane crashes.
Mhm.
No, the law of gravity is what it is, right? Don't
Mhm.
come up with like complicated formulas to try and change the law of gravity. Let's just deal with things the way they are. And that's the goal in my book, is to really help people understand the truth of how an economy really works, of what money really is, and how your wealth is taken from you or how you may be benefiting from somebody else. Once people have an understanding, then it's much easier to make difficult decisions, and it's much easier to have empathy for your fellow citizens in terms of what they may
Mhm.
be going through. But until we, all these myths are done away with, it's going to be really hard to change things.
So the 2% inflation rule, I just think about, well, you want things rising in value, so the cost of everything is rising, which we are really feeling right now. The cost of a new truck, I mean, my goodness, the cost to build a home. What is your rebuff to you need inflation to grow the economy? How do you grow the economy without the inflation?
Yeah. So again, inflation is not growing the economy; it's just growing prices, right?
It's an illusion of yeah.
No, exactly,
But your GDP grows because you're moving more money for the same amount of assets.
exactly,
You're buying 10 pieces for more monies. It looks like you're growing the economy. It's an illusion.
exactly. That's exactly what it is, and and it distorts things as well. It harms the economy. It's not just an illusion. And so central banks, they believe, or at least they've convinced themselves, and politicians that you need inflation, at least some inflation. Otherwise, people won't spend their money. It's a complete joke.
Mhm.
So they call it the paradox of thrift. Now, so like if you decide you're not going to spend your money, so a central banker will think, well, you're not being very nice because you're by not spending your money, you're denying somebody else of an income. How dare you? So they try to get you to try to force you to spend your money by creating some inflation. So you'll spend your money because you know the prices are going to be higher next year. So I better spend my money today. So they want people to spend the
Mhm.
money as quickly as possible. So a couple of things to explain why this is complete and utter nonsense. So first of all, just because you don't consume or spend your money doesn't mean that your money is not spent. If you save your money is spent in a different part of the economy. Your money is spent in the what's called the intermediate goods side of the economy. Your money is invested, and so the classical economists talked about this a couple of hundred years ago. John Stuart Mill talked about this. So, but the trouble is spending on intermediate goods is not final spending, so that's not included in the GDP number. So if you're investing your money and that's being spent further up the economy in terms of building a tractor or stuff, but that doesn't get captured in GDP, so they don't like that. So that's the first thing. The second thing is that you don't need 2% inflation for you to decide that you have to spend your money. So I use an example in the book. And by the way, you know, I'm sort of cutting corners here in our discussion. In my
Mhm.
book, I go very carefully and slowly, step by step, so people will understand. I use analogies and stories and stuff. So, the central bank thinks because we're all idiots, right? We all need to see 2% inflation, otherwise we won't spend our money. So let's say, so they would assume 0% inflation would be catastrophic for the economy because no one will spend their money. So let's assume instead of that, it's actually 2% deflation. So prices are falling 2% per year. So central banks would then conclude that no one will spend their money because they will wait a year and buy things 2% cheaper. It's nonsense. So let's
Mhm.
say you own a TV and you want to buy another TV for the basement so your kids can watch TV down there and not make a noise upstairs. Now, so it's a luxury. So let's say that the TV costs 300 bucks. There's 2% deflation, falling prices. So the central bank thinks you're not going to buy that TV, right? No, of course you are. They think that you're going to wait 12 months and save $6 on that TV,
Mhm.
and you're going to buy it for $294 instead of 300. No, of course you're going to buy it today, right? And so it doesn't
Mhm.
take a lot of scratching the surface to see what's really going on underneath. And but it's this received wisdom that everybody they want to believe it because it justifies printing money, it justifies deficit spending, it justifies governments buying votes, if you will. I mean, and
Uh,
this is
Yeah.
not about left versus or liberal versus conservative, or definitely not in the states, Republican versus Democrat. It doesn't matter who's in charge. Deficits and debts just keep growing. You know, we always have inflation. We always have rapid increases in the money supply.
Right.
And again, not bad people, but that's this, they're convinced that this is the right thing to do.
Well, they've got themselves caught because they've had this investment strategy for a long time now, and they've got the ball rolling down the hill, and it's very hard to stop it. Like you said, to stop it, a lot of people are going to feel a lot of pain.
Yeah,
But one of my thoughts, and you can let me know what you thought on it, is I think the government grossly overspends. The money we send out just for no good reason, in my opinion. Just for, I mean, the Ukraine war can be one thing, but I think that overseas spending, investing money overseas rather than making things here, and the way we have a chokehold on our oil and gas industry and refuse to really develop that industry, we just are overspending on projects that aren't earning us any return. So if we reduce government waste, had interest rates at the optimal rate you were talking about, 7 or 8%, where you thought twice about borrowing the money, and then you lowered to offset the savings the government had, you lowered personal income tax and made people wealthier that way, where they could save up more for a larger down payment on a home and have to borrow less against a higher interest rate.
Yeah.
To me, that would just be great. People are making more money. They're still spending it. People are going to spend every dollar they have. I mean, that's the point of money. It's getting spent. What's your opinion on that philosophy on trying to correct some of this and making people wealthier and taking smaller mortgages?
No, everything you just said is 100% correct,
Yeah.
right? I mean,
The government can't stop wasting and they do not want to. And
no.
lowering income tax would be great. I mean, the government could easily offset a tax reduction with the waste that they would save.
Oh, 100%. And the trouble is incentives. And I talk a lot about this in my blog and in my book that, there is a lot of government waste. Government is not efficient because it doesn't have to abide by the law of profit, you know, and um, and it has no skin of its own in the game. All the capital it has comes from somewhere else, like we said earlier. Now, it doesn't mean that people in government are lazy. Doesn't mean that bureaucrats are lazy. Some are. I mean, I've heard some horrific stories in the past
Mm-hmm.
of people, you know, but a lot of people in government work extremely hard. I know people who work in government work just as hard as people in private sector.
Yeah.
And it's not about bad people, but it's about bad systems. And incentives matters, like Charlie Munger, who used to be Warren Buffett's right hand man. He said, "Show me the incentive, I'll tell you the action."
Mm-hmm.
And so, bad systems, bad environments, bad corporate cultures, also in the private sector, can bring out the worst in very good people, and vice versa. And this is not just a Canadian problem. This is a problem everywhere, and that's a that's a tougher nut to crack, I think. Well, maybe not. I don't know, but it's not really the main focus of my book. I just sort of acknowledge it,
Right.
and yeah, but the just encouraging um, more accountability. But I don't know how you do that within government. I mean, I think they have been taking some actions recently,
Yeah.
but it was going the wrong way for such a long time, and I think in part it's because people, all this tax revenue that the government takes in, they don't see the hardship that people are going through as a result of having to pay so much in taxation. And it's not just income taxes, right? It's property taxes, it's sales taxes, whatever. And by the way, that's another thing that really drives me nuts. Property taxes. Yes, you need to fund your police and fire and stuff like that, and waste collection and whatnot. But property taxes, why why they go up whenever house prices go up. Why
Mm-hmm.
is it becoming more expensive to run the government just because house prices went up?
Mm-hmm.
No, it's just a tax grab. If anything, property prices should be going down, right? If the city is growing in population, you're going to have economies of scale. Now, not all aspects of the municipal government are going to scale like that. If the city gets bigger, you need more police and blah blah blah. But a lot of aspects would scale very well, and so the per capita property tax should be going down, not up. Also through investment. So companies, they invest in their businesses to make things more productively, be more efficient. what happens when they do that? It increases the profitability. That higher profitability in an industry attracts more competition, which drives the prices down. And then companies invest more in their business to make things even more efficiently. That drives the prices down even more. And the ultimate beneficiary is supposed to be the consumer. So you've seen that in TVs, like flat screen TVs
Hmm.
back in the early 2000s. They were like $3,000. Now you can get one for 300, and it's even better. Right?
Hmm.
But the reason this doesn't happen in a large part of society is because the central banks are increasing the money supply at a faster rate than the economy can increase the amount of stuff. In the late 1800s in the US, you had stuff growing faster than the money supply. So for 30 years, you had prices falling. It's called good
Hmm.
deflation. So even if you're on a flat wage every year in real terms, you become wealthier. So in government, they should be also invest, and they do invest, but it should be becoming more efficient. They should be able to do this stuff at a lower cost, but they don't because they
Hmm.
just the more it's like you know it's like any departments or whatever. When you have a budget, you got to spend your whole budget. Otherwise, if you don't, it's going to be lower the next year.
Yeah.
And I don't blame them for doing it because that's sort of the incentive. That's sort of the structure. But yeah, but it's it just increases the hardship um, on the average person when
Hmm.
property taxes are going up.
Well, property taxes, and you almost think they should structure it like a condo fee. Everybody pays the same fee, but I mean, you have low income housing and you have cheaper houses and bigger houses, but and people can afford more and afford less, but you have to find some medium. It can't be, let's keep testing the market and see how much people can afford, and let's reevaluate the home prices. Well, it's people aren't evaluating how much you put down on your home and how big your mortgage is. They're just going off the value of your home, not necessarily how much you can afford.
Yeah.
And then just back to my point, if the government reduced wasteful spending, increased the interest rates, lowered the income tax, would you see rent prices then increase and people raising the prices of their products to just test the markets and see how much they can extract for a product because they think the individual is wealthier?
Um,
But the rent prices might go up because, well, the people that own the house are now paying 8% for the house,
mhm.
but they know people are making more money, can afford more. So would it just be a double-edged sword?
So in a free economy with freedom of competition, then I think you would see declining prices rather than prices
Hmm.
going up. And you know, it's not just zero interest rates that drove housing prices higher. I think that kick-started the whole thing, but then, of course, immigration far in excess of the country's ability to increase the housing stock played a big role. Um, all the bureaucracy and the regulations and NIMBYism and stuff like that, all things that you can understand, but just we have way too much of it in Canada. And then in cities like Toronto and Vancouver, at one point, about a third of the cost of a new build was government fees and taxes. It used to be like 10%, but they kept
Yeah.
increasing it. And in my opinion, they did this because it's like an invisible tax, because the homeowner, when they buy the home, even though it's 30% more expensive, they can't see that it's taxes and fees. They just see the final price. And then the government assumes, oh, the builders will just eat it. No, they didn't. They passed it on to the consumers and contributed to the affordability crisis. And it's terrible. I mean, it's absolutely terrible what they've done. And because they thought it
Hmm.
was a free lunch, these municipalities, they thought it was a free tax revenue grab, and it would only be greedy house builders that are going to suffer from it. No.
Well, it seems like big government just wants to extract every dollar from the individual that they possibly can, always. They don't want you to they don't want you to have cash. They want you to have debt and they want you to keep servicing that debt till the day you die. And it's just seems that's where the mentality is gone. You know, everybody said, "Oh, my grandpa never borrowed a dollar, nor would he. It was cash or nothing."
Yeah. Yeah.
And now it's like I said, you borrow for everything. So I don't know what is for young people today. What is the strategy that they should take with their money? What is an investment strategy? Where should they be borrowing, and where should they be? Well, obviously not spending too much, but
Yeah.
what do you
So,
tell young people today?
yeah, well, first of all, so I'm not licensed to give financial advice, but I can give you some broad
No, yeah,
recommendations. And to your point, life is happening now. I mean, the goal of my book and my blog is to make the world a better place. Maybe naively, I don't know, but anyways, that's my hope.
hmm
But life is happening now. And so the first thing, like if you are saved, I mean, save, you got this thing now, YOLO, right? You only live once, or blah, blah, and, and people, I mean, it's sad to see that people are giving up on saving because well, if I save this much per year, I'm going to be 60 years old before I have a down payment for one of these ridiculously overpriced homes. So I might as well live my life now. So I kind of get it. But people should save. And it's tough. It's not easy to save when the cost of living went through the roof after COVID. And it wasn't because of supply chains, by the way, it's because the central banks exploded the money supply higher. And I talk a lot about this in my blog. And so find a way to save. Um, if you're buying a home, don't be tempted to buy something that, don't be talked into buying something that's sort of, out of range. That just because you can afford a monthly mortgage payment today doesn't mean that you should be buying a home of a certain size. What can you, what sort of uh, size house can you be comfortable with? And then when you're investing your money, um, I mean, all I can say is, what I do. I mean, I invest in the mutual funds that I used to manage were called Ivy. They're at Mackenzie and they're very high quality. And I never look at my portfolio. I never look at what the funds hold because I know what my team is doing and how they invest the money. I know it's in about 40 very high quality companies from around the world who are putting that capital to productive use. They have strong balance sheets, all that kind of jazz. Have some high quality bonds, maybe a couple. Make sure you're investing in things that you understand. If it sounds too good to be true, it usually is. I mean, we've all heard these stories, right? And I know a lot of people personally who lost a lot of money because they were sort of sold a dream of quick riches schemes and stuff like that. So if it sounds too good to be true, it probably is. Have a little bit of cash, emergency cash, and some high interest savings accounts and stuff like that. I also have a small percentage of my portfolio in gold. Now, gold is not a productive asset, just like a home is not. Um, However, the difference is that gold is actually held as reserves by central banks and houses aren't. Or so that's the difference.
hmm
And so I call it my central bank lunacy hedge. And so if central banks, some people will tell you that the only way out of this monumental debt pile, this debt mess, this debt fuel consumption joke, disaster, is financial repression. Financial repression is essentially central banks printing money to buy bonds to keep interest rates extremely low, but it will result in inflation. So your asset wealth will be inflated away
hmm
by central banks. Now, if that is the path, gold will do extremely well. Now, ironically, if they decide to fix the system, our fiat currency system, which is what we have, and stop rapidly increasing the money supply, then that wouldn't be good for gold. Gold price would probably fall. But that's why I view it as a hedge rather than an investment.
hmm
One final thing to say about it. if they do decide to fix the system and go to a gold standard, I mean, I doubt that they would. I think the world would be a much better place if we were on a gold standard. Then price of gold will probably do very well. So I don't know what's going to happen. Nobody else does. But I have exposure to the real economy through my investment in the Ivy funds with high quality businesses. I've got some cash for emergencies and stuff like that, or the option. So if things crash, I can allocate my cash cheaper price. And I've got some gold, which is my central bank lunacy hedge. So that's how I
Mm-hmm.
approach it. Um, you know, there are lots of people who will give you an opinion with respect to what's going to happen. Everybody wants to hear somebody else's forecast. Nobody knows what's going to happen, right? And you can listen to two very smart people tell you what's going to happen, and they're exact opposite, and they both sound very compelling. One of them might be right, but it's not that they're not educated guesses, but it's still really luck. And because I don't know what's going to happen, I never position my portfolio or my investments assuming that I did know what was going to happen.
Mm-hmm.
And investing is a very humbling business, or at least it should be. And so, yeah, I would just reason I'm saying that is just for your listeners to be wary for those who seem to have all the answers. Hedge your bets,
Diversify.
diversify. Yeah, absolutely.
Diversify. Do you think you should buy a home if you can? If you come out of university at 23 and say you're a doctor and you're making a very good living and you can get a good mortgage, should you do that right away, or should you save up cash and buy when you're in your 30s? Is there any benefit to that?
So uh, I just think it's a very personal decision.
Mm-hmm.
I really do. Like
Yeah.
some people will say, like that, you can do the math and say, well, what's renting today versus buying today? Well, a lot of that's going to depend on what rents and house prices are in the future and what interest rates are. And
Yeah.
I don't know. And so generally, I would say that someone coming out of school, if you could afford to buy a home and maybe it's because you want to start your family, or maybe not, you just want a home, that's your prerogative. And then
Mm-hmm.
go ahead and buy it. But don't
Mm-hmm.
don't buy it based on your assumption of what you think the price is going to do in the future.
Mm-hmm.
Because you may be happy with the outcome, you may be terribly disappointed. And
Mm-hmm.
for some people, it can ruin their lives.
Mm-hmm.
So make sure you're doing it because like you said earlier, it's a place to live. It's a place
Yeah.
to raise a family. No, don't do it because you think this is the only way I'm going to be able to retire with my home price going up
Right.
10% per year for the next 30 years. The might thing might
Yeah.
be cut in half. But
Right.
if you're buying it to live in, of course, you're not going to like it if it gets cut in half, but at least you're not going to be affected by it financially. Your mortgage
Yeah.
payments are still going to remain the same.
What do you think would happen now with this Venezuela business? China was, I think, pushing to get the global oil currency traded in the yen. I think that's what they would kind of like. What would happen to gold if that were to happen and if the US dollar collapsed? Do you think?
Well, it'll go
Do you
up.
think that'd be good for gold?
Well, if the US dollar collapsed, the price of gold would go up a lot in US dollar
Mm-hmm.
terms, at least. I don't know what it would go up in terms of other currencies. Um, and, I would say that, geopolitics is less of a focus for me.
Mm-hmm.
Like it's enough trying to figure out things from a monetary policy and how a GD or how an economy works perspective. And,
Mm-hmm.
as an investor, the one thing I discovered, well, I discovered a number of things the hard way,
Yeah.
that, A, it's really hard to predict geopolitical events. And
Yeah.
I never would have dreamed that the US would have gone in and plucked out Maduro. Like, I was
Mhm. Yeah.
and
Yeah.
and so they're impossible to predict. I say again, you might get lucky, um, but when those geopolitical events do happen, how markets respond to those events is often the opposite of what you thought it would be.
Hmm.
Sometimes it's not, and so so if you don't know what's going to happen, and you don't know how markets are going to respond, I just said, well,
Yeah.
why am I going to worry about it? It's not that they're not important. It's
Yeah.
not that they're not interesting to discuss, and not that they don't have consequences. Of course they do. But I just focus on the things that I think that I can predict. That yes, I do think that printing money and debt fueled consumption is bad for the economy.
Hmm.
And people will say, well, look at Japan, their debt to GDP is 250%. Nothing bad's happened yet. Well, actually, it has. Their real economic growth in Japan has been like non-existent for 30 years.
Hmm. Hmm.
And eventually something really bad could happen, but it doesn't necessarily have to happen. If you just have flat
Hmm.
economic growth or slowly decline, that's really bad. It's like saying that, you see someone and they're a heavy smoker and they drink a lot and they got a bad diet and they don't exercise. And you say, hey, better smarten up. That's not good. And then 10
Yeah.
years later,
Nothing's happened yet. They look fine.
yeah, 10 years later, they haven't had a heart attack yet. So, hey, I
Yeah.
guess you were wrong, Musson.
Yeah.
You know?
Yeah. Yeah. I guess protection and diversity would be the one thing to do in uncertain economies. I guess one final point is, what is your a publicly traded company? To me, just seems like that's where they take a fork in the road to go public and get traded on the stock market. Now they become hooked on growing their share price
Yeah.
because that is what's going to get people to invest in their company and generate a return. The consumer is ultimately the one that generates that rising share price, I would think.
Yeah.
So it almost seems like the second you go public, you're kind of selling your soul a little bit.
Well,
What's your opinion on that?
yeah. So, yeah, I mean, I hear you. So the answer is yes and no. It depends on the company. And, when we were analyzing companies, obviously over the years, I looked at a lot of companies and a lot of different corporate cultures. And so a lot of companies these days, to your point, are more focused on the share price than the customer. And so they try to drive their share price higher. So one way they will do it is by taking on debt and buying back shares. Now, there's nothing wrong with buying back your own shares as long as you have excess capital and as long as your share price is not too expensive. But these days, a lot of companies buy back shares even though they don't have excess capital. So they borrow more money, put it on the balance sheet, and their share price is expensive. So this is a real disservice to the shareholders that remain in the business. And they will also look to extract. So a lot of career executives do this. These are executives, not all career executives are bad, by the way, but or financial executives. They're they've come out of school, MBA school, or whatever. They never started their own business. They don't know what it's like to run a business of their own. And so they focus on the numbers rather than the customer. And so they'll look at how can I extract value from the customer? How can I extract value from the customer value proposition such that I can get the customer to pay the same price for less value that I'm giving them? And so, and eventually that catches up with you
Mhm.
because of competition. Now, good corporate culture companies, and there are a lot of them who are publicly listed. Now they come under enormous pressure from Wall Street to take on debt and buy back shares and cut costs, and you'll see this often right when New CEO comes into a business. First thing they do is they lay off 10,000 people. We're cutting on costs here, R&D and that, blah, blah, you know? So
Mm-hmm.
they're sacrificing the future growth of the business for today's profitability, which drives the share price higher in the short term. Cash in your options and go on to the next challenge, sort of thing. But good corporate culture companies are often, not always, but often run by entrepreneurs or career executives who behave like entrepreneurs, who just love whatever it is the business does. They just love providing their customers with more value, seeing their customers be more excited about the customer value proposition. And so cut costs, reduce the price of the product, reinvest in the business more, pay their employees more. And so these businesses, there are six broad constituents for a business model. And so we would look for businesses where all six of those constituents were benefiting. So it's not, so senior management needs to benefit, the shareholders need to benefit, but also the suppliers, also the employees, society at large, and then finally the customer. So if any one of these constituents is getting screwed in this business model, then the business model will not persist in that
Mm-hmm.
form. And the customer is the most important constituent out of all six because the customer is the only one that pays, right? Everybody
Yeah.
else takes.
Yep.
And when you see that happening, it's a beautiful thing. And that can give you confidence with respect to the sustainability of that business model. You don't know what the world is going to look like. You don't know what geopolitical events are going to happen or occur, how the markets will react like that. You don't know what interest rates are going to be. But I know that this management team is going to continuously reinvest in the business and fairly share the spoils with all the
Mm-hmm.
constituents. It doesn't mean that the shareholders aren't making more, you know, but everybody's going to be fairly compensated. And I'll finish off with one quick example. I
Mm-hmm.
talk about this in my book. A company called Fastenal. It's based in
Mm-hmm.
Minnesota. They distribute like screws, nuts, bolts, stuff like that. Not a really exciting business. We had a tour of their plant years back, and plant manager, he's so excited. He loves the company. All the employees are so excited. So I said, "What's going on here? How come you guys love this company?" He said, "Oh, well, the ownership, management, they love us. They respect us. They want to hear what we have to say, and we all share in the success of the business." And then he gave me an example. He said the CEO was the founder. He owned about a third of the company. Years prior, his wife had passed away, and she owned a good stake in the company as well. When she passed away, the CEO took all of her shares and distributed them to all the employees in the company. Now, I'm pretty sure he didn't do that thinking, well, if I do this, I can get these jerks to work more overtime. No, he loves the business, he loves the people. Because he was the founder, like he started small and probably did every job in that business at one point or another. So he knows what they're going through. He knows the challenges that they're facing
Mm-hmm.
on a day-to-day basis. He has empathy. Like if you're a career executive, you go straight into the CEO position, you don't know what it's like to do all those different jobs, right? Not that you're a bad person, you just don't know.
Mm-hmm.
And there are a lot more companies out there like Fastenal than you think. You just don't hear about them. You just hear about the really bad companies, and rightly so. You should hear about them.
Mm-hmm.
But there's lots of good things going on. I guess I painted a negative story here, but there are also lots of good things going on. And the only reason the economy is still growing to any extent is because of that, because the entrepreneurial spirit, the hard work, the work ethic, the intelligence of the average person helping each other, wanted to. That's the reason it's growing, not because of central banks.
No, no kidding.
You know,
Great point. So your blog and your book, I've seen your book. Amazon Prime can pretty much be had anywhere. And it's called.
so
Sorry, what was the
yeah,
name? The Capital Offense: Why Some Benefit at Your Expense.
yeah.
So you go through all this in great detail. Probably a great read for anybody, especially young people. I would imagine would benefit greatly from it today.
Yeah, I mean, I
And
think
you
so.
do,
I mean, that's who I wrote it for
yeah,
primarily. I wrote it for all ages, to be honest with you, and I've had really good
yeah,
feedback from people so far.
that's great. And where can people find your blog?
So my blog is Paulitical Economy, and it's on my website, which is Paddington Capital MGMT.com. So MGMT is short for management. You can also reach it
Mhm.
by pauliticaleconomy.com. So
Yeah.
PAUL economy.com. And so it's a free blog. It goes out once a week. And I've got all my past posts are on there. And so I've been writing it since 2022. And I've got lots of interviews like this up there, book summary, stuff like that, and links and stuff like that. So people can have a look, and you can put your email in, and you'll be notified when I send out a new post out.
Oh, it sounds great. Well, I'll definitely check that out. Thank you very much for coming on and your insight. It's been a super interesting conversation, especially given the global climate today. So greatly appreciate it.
Well, thanks for having me, Logan. It was great.
You bet. You take care.
You too. Bye bye.